Hello and welcome to Pro Trader Strategies Market Commentary for Friday, November the 16th. My name is Eric Wilkinson, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also, remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. Across the pond, we got some CPI numbers out of Europe, but remember their flash estimates are the ones that are most important, but consumer price index for that number came in line with expectations. Then we come back over here to the United States, and we got our capacity utilization and industrial production. Now, it's not one of the ones that is most widely looked at by the street, if you will, but I think it gives us a really good picture of what the manufacturer is thinking going forward. That's why I believe this is more of a forward-looking data point than most other people do. If the manufacturer is cutting back on industrial production, then that means it's because they believe that the economy is slowing. So, industrial production came in slightly below expectations at 0.1%, expected to be 0.2%. It is still positive. But last month's number was revised down from 0.3% to 0.2%. So that revision makes this all unchanged for the headline number. So not in negative territory, but just treading water. Capacity utilization came in at 78.4, which was in line with expectations. Last month's number did get revised slightly higher, so that's a good thing there. And that's about it for the economic data points. On to the overall markets, we've got crude oil trying to push higher today. You know, this is one of the biggest slides crude oil has seen in several years. I can't remember exact date, but it has been quite a few years to have this type of market movement in crude oil this quickly, going from $76, almost $77 to $54 in the matter of less than 2 months, less than 60 days. Just a straight down drop, okay? So it's got to be overdone to the downside, at least for the near term. Now, I tweeted out yesterday, I think that $40 a barrel oil is probably closer to reality than what I was originally thinking. I think it was going to stay between, maybe high 50s, mid 60s kind of thing. I thought that that's where the wheelhouse should be. Now I think we're a little bit overdone to the downside, but we could just get a dead cat bounce. We've got a lot of resistance above us with these Fibonacci extensions, and then the value area low for the all I can think of is Stoudemire for the blue Stoudemire, which is where it represents time and volume, where the most time and volume has been spent. We are extended quite dramatically outside that, but you can see price has been being accepted down at these levels. So we could create a big node here. But crude oil, a lot of supply out there. Doesn't look like a whole lot of demand. So if there's somewhat of a bounce here, it might very well be a dead cat bounce. Just be very aware of that. All right, let's talk about gold futures. They're moving higher, as usually we see a flight to safety here in gold. But that tantrum with the equities is close to being over. I think that the Fed is getting the idea that they need to pause. That's what the market has been signaling. I've been talking about this till I'm blue in the face, that there has been several different indicators as to the Fed needs to pause, and a lot of these are coming to fruition now, and people are now even talking about it on Twitter besides me. But we've got gold moving higher with a mixed bag in the equities. At least last I checked, Dow was down, the rest of the market was up. We've got Bitcoin moving higher. Something to talk about with Bitcoin. That big liquidity event we talked about, this big slide. When we see that big kind of that slide we saw, that usually is a liquidity event. Now, what people are going to do is they're going to go to try to cover whatever they are least confident about or what has been underperforming the most. And Bitcoin is probably something in those portfolios that people were looking to cover, and that was the catalyst. We got that big sell-off. Yesterday made it look like a nice little bottom. Today, though, we are going to need to get and settle above yesterday's high, which was 59.65. So, or sorry, 55.65 is the high here. So some settlement above that would be quite nice for another $100 to the upside, let's say, in Bitcoin for a settlement to make that look like a confirmed bottom. Looks like we found a lot of support. Remember, at these levels, miners aren't making money. They're losing money, which is going to lead me down the road to what I was going to talk about for my earnings trade. At these levels, miners may be breaking even because the cost to produce a Bitcoin, the energy amount and the cost to build that Bitcoin is basically a break even right around where the point of control is right here. So we are extended to the downside. When they're not making money, that means they probably aren't producing as many Bitcoins, right? They're going to cut back on production. If they cut back on production, that means they're cutting back on supply, and hopefully that would drive the prices higher is what, conventional wisdom, if you're bullish in Bitcoin, would think. So we need a confirmation to the upside on that trade in order to get any resume to the upside for the crypto. All right, now looking at bonds, they're moving higher by close to a half a point. We've been talking about this. I think that the market has signaled to the Fed that they need a pause. Now, whether or not the Fed is going to put that into and be able to process it is another story. But we've got bonds moving higher on the expectation that interest rates aren't going to increase as rapidly as what was perceived about a week ago. All right, the VIX coming off a little bit today, even though we have a mixed bag in the equities with the Dow Jones Industrial Average up only about 28 points right now. Literally 5 minutes ago, it was up probably 60 points on the day. We are right in and around where the most time and volume has been spent. I don't think that there at this point is a lot of energy in order to get us out of this rut in a sense. When we get close to that magnet, which is the point of control where the most time and volume has been spent, the market really wants to stick there. And I don't think that there's been enough of a catalyst in order to separate us from this. Maybe if the Fed's governors that started speaking started saying maybe we're going to hold off, that could be the catalyst to spike us higher. But at this point, we're right at the point of control. It's going to get a little bit complacent here. I think we'll start to see volatility really come out of these markets as we stay in and around these points of controls in the equities. You can see a similar situation here in the NASDAQ, albeit it is negative on the day by about as much as the Dow is up. The point of control is resting right in and around this area. We've got a lot of support below us for the NASDAQ. We've got a bit of resistance to the upside on the Fibonacci extensions. But all that being said, when we are right at the point of control, there's a bit of complacency until we start getting a catalyst to get us out of that. E-mini S&P is negative on the day, as you can see here. But again, I'm talking about we are at the point of control with all the equities across the board. It's going to need a good kick in the pants to get out of there. And that's going to have to do with economic data points maybe next week that we start to get. And then E-mini S&P is on the 30-minute candle chart here. Each blue section is a day, and that is the Stottlemyre. Anyway, so overnight inventory got a little bit short. Coming into the day session, we got that economic data points. It wasn't terrible, but it wasn't robust enough to get us out of this rut that I've been talking about, but enough to give us a little bit of buoyancy in the equities, as you can see coming into the day session, peeling to the highs of the day, basically retracing the entire day so far. So right in the middle of the road right now with equities on the day. Now, NVIDIA, I was talking about this with the Bitcoins, right? Bitcoins basically flatline right around the break even on producing one Bitcoin and the energy it costs to produce that Bitcoin. So yesterday I tweeted out I'm going short NVIDIA calls because I don't really see a lot of these miners going out and buying tons of servers in order to mine Bitcoins at the current levels that we're seeing in crypto. That was what happened in NVIDIA. They even mentioned it in their call. We got a big drop, which helped me out because I sold the November 230 calls in there for $1.32. Now, I didn't say I was doing that exact strike on Twitter. It's because you guys watching these daily market commentaries and the earnings know I'm shooting for that 16 delta call or put, depending on my directional assumption. This, I went just slightly outside of that. It was a 14 delta, just so you guys are aware of that. I default to the 16, but if I can get a nice chunk of change like $1.32 on a 14 delta, who am I saying no? Anyway, I was able to buy those back for a penny, put a resting order in before the open, and somebody came in and slammed us with 250 contracts. That's not what I had on, but that's what somebody opened the trade with. So got out of that for a nice little profit. Working a couple other trades to get out that aren't really close. It's just a quiet Friday, and figured I'd put in a bunch of these trades in order to be ahead of it if anything crazy were to happen or anything that I missed. Because with this XRT trade, which is the ETF for the retail sector, I've had a couple opportunities where it's gotten close, not quite to my spot, but it's been when I've gone back to look at it that I've realized that I may have missed a couple opportunities there. I'm about 40 cents away from it right now, and I'm doing the December, if you remember, the 45.52 call spread, put spread in there, and looking for the down move. Closest we've gotten is about 46. I was looking for it to go down and print on those 45 puts because I'm long 52 puts, short the 45 puts. But if I get down there and get tested on those 45 puts, I should be able to reach 50% of my max profit on that trade. And so I paid $3.20 for it. My max profit is about $3.80. So if you figure a $1.90 increase on the $3.20 I bought it for, it's about $5.10, $5.20. I'm working a $5.20 offer to get out of that. It's trading around $4.80, $4.90. So I'm a little bit away on that one. But if I see a bit of a pullback in the later parts of the day, I might be able to get that one. And then also trying to get out of Under Armour, ExxonMobil. But like I said, those aren't really close. I've just had working orders in on them. And that's about it. Other than check out yesterday's webinar on synthetic shorts. In a bearish market, these are great products for a bearish directional assumption in any underlying. You will get dollar for dollar move as a stock. So that's why it's synthetic. Every dollar move down, we gain a dollar in our option strategy. It acts exactly like the stock. And I talk about the correct environment, how to find the right strike locations to build this out to increase your probabilities of success. So check it out at protraderstrategies.com on the synthetic shorts. I also did one last week on the synthetic long call or a synthetic long stock as well. So check both of those out. Great for a strategy of a person with a portfolio struggling to find enough money in their account to buy another stock. Well, if you built your portfolio out with these type of strategies, you would have enough margin to increase your diversification. And I talk about all that in that webinar. So go check it out. Also, give me a thumbs up, thumbs down on this video, like or dislike. If it's a dislike, let me know what it is that you disliked about it. All right. So that's about it. Other than if you can't take that, take it easy.